Good morning and welcome to your daily solo 401k webinar Q&A session with my solo 401k financial, where we try to help you to stop overpaying taxes and start building real retirement wealth through your tax shelter retirement account, whether a self-directed IRA or a self-directed solo 401k or even both. So today's topic is what happens if you have a solo 401k and then hire employees. Again, this is your time to ask questions as well. They can be surrounding today's topic or any other aspect surrounding solo 401k plans and even self-directed IRAs. Go ahead and type them over so that we can be sure to get to them all. I don't see any questions at the moment, so let's continue here. So just like it's important to understand what the rules are when you open a solo 401k plan, it's also important to understand what the rules are once you have to close a solo 401k plan because you hire employees in your business. So let's first talk about what a solo 401k is. So a solo 401k, also known as a one participant 401k, is designed specifically for self-employed business owners with no full-time W-2 employees other than the owners and spouse. So you may have multiple owners, and the multiple owners can participate in the solo 401k, and even their spouses can also participate in the solo 401k plan if they are also working in the business. But more importantly, which is the subject of today's topic, is what happens when your business grows and you hire employees. So this is a common and good problem to have. Growth is a success story, right? So hiring employees can impact your solo 401k's eligibility and compliance requirements. So let's break it down clearly. Let's take a look at here. Well, we got a question here. Does your platform integrate with Gusto Payroll? So our solo 401k plan is robust in that you can use any bank or brokerage firm to hold your funds, and you can integrate it with Gusto. Let me send you a link from our website that talks about how to integrate your solo 401k plan with Gusto. Give me a moment here. Here's a good link from our website surrounding how to do that. So take a look at that. It's a good question. Okay, again, go ahead and type over your questions, and we'll go ahead and continue to answer those questions as they come in. In the meantime, let's continue here with today's topic, which again is, give me a moment, let me get to my slides here. Okay, so today's topic is what happens if you have a solo 401k and then hire employees. So why does the solo 401k have an employee limitation? Well, a solo 401k is exempt from many complex ERISA testing rules because it covers only the business owner or owners, the owner's spouse, or the owner's spouses. So again, you can have multiple owners in the same solo 401k plan. So once non-owner employees become eligible, the plan is no longer considered a one participant plan. That's how the IRS oftentimes refers to a 401k for the self-employed. They refer to it as a one participant plan. So at that point, you must either cover the employees under a qualified 401k or transition to another compliance structure. So we'll talk about that other compliance structure in a moment. So understanding the employee eligibility rules. There are two key employee categories that determine when action is required. There's the full-time employee rule. We like to call that the traditional rule. So let's discuss that traditional rule. So under long-standing IRS rules, an employee generally becomes eligible if they work 1,000 hours or more in a 12-month period. And this applies to W-2 employees, not contractors, because you can always exclude contractors from participating in a solo 401k plan. So when we're talking about full-time employees, we're talking about full-time W-2 employees who are not owners in the business, but rather, using IRS terminology, common law employees. So again, the computation period is if they work 1,000 hours or more in a 12-month period. And you can always exclude those who are under age 21, regardless of how many hours they work. So if you employ a W-2 employee in your business who is not an owner, but he or she is age 21 or older, then if that individual works 1,000 hours or more in a 12-month period, starting from the date of hire, then that's going to result in your plan having to be converted. And we're going to talk more about that. So you would no longer be able to continue with that solo 401k because that's the full-time employee rule. So if you hire a full-time employee who works 1,000 hours or more and meets age requirements, your solo 401k must be converted into a traditional 401k covering employees or be terminated or restructured. And we'll talk more about that in a little bit. Now let's talk about the long-term part-time employee rule, oftentimes referred to as the LTPT rule. We get to that slide here. So the long-term part-time employee rule was introduced under Secure Act 1.0, but then it was expanded by Secure Act 2.0. So the current rule under Secure 2.0, which was the latest update, that means that employees, again, W-2 employees, must be allowed to participate if they work at least 500 hours per year for 2 consecutive years, assuming they are age 21 or older, because again, you can always exclude those who are under age 21, regardless of how many hours they work. Now, this long-term part-time employer rule, originally the rule required 3 years, but again, Secure Act 2.0 reduced it to 2 years starting in 2025. So again, from a timeline perspective regarding when this rule went into effect, the long-term part-time employer rule, that is, it started in 2021 through 2024. It was a 3-year period, but then resulting from Secure Act 2.0, beginning in 2025, it reduced it to 2 consecutive years instead of 3 years. So the key is that that W-2 employee has to work 500 or more. So technically between 500 and 999 hours for 2 consecutive year periods. So you may have a W-2 employee that may work between 500 and 999 hours in year 1, but then the second year, he or she may work less than 500 hours. Let's say he works 499 hours. Well, that's going to start that 2-year period again because it's a 2-year consecutive period. So if you have part-time employees consistently working 500 plus hours annually, they may trigger eligibility even if they never reach 1,000 hours. So don't confuse the long-term part-time employee rule with the full-time employee rule. You can always come back and listen to this webinar. We're also going to post this on our website as a blog post so that you can refer to it. Now let's talk about when you must comply. And before we get to that, let me get my slides ready here. So when must you comply with these regulations? Okay, so you must allow eligible employees to enter the solo 401k plan. So by the next plan entry date, often quarterly or semi-annually. And to clarify, they would not enter the solo 401k plan, but rather your solo 401k plan can be converted to a full-time employer traditional 401k. And then you would need to offer it to those eligible employees by the next plan entry date, which is often quarterly or semi-annually. It just depends. And also after they satisfy the service requirements. So failing to comply can create qualification issues with the IRS. Now let's give an example here regarding the entry date. Let's say that that your business hired an employee. Let's say that employee is a W-2 employee. Let's say his name or her name is Sally. Let's say Sally started working for your business on November 5th of 2024. And let's say that Sally's first 12 months of work for 401k eligibility purposes will be from November 5th of 2024 through November 4th of 2025. Therefore, if Sally works 1,000 hours or more between November 5th, 2024 and November 4th of 2025, then she has met the 401k eligibility requirements. So as a result, because there are 2 plan entry dates for a 401k, the entry dates are typically January 1st and July 1st. So depending on when in the year the W-2 employee met the 12-month and the 1,000 hour eligibility requirement, the solo 401k will need to be converted to a full-time employer 401k and offer to the W-2 employee, so in this case, to Sally. So based on this example that I just gave, if the solo 401k is not converted to a full-time employer 401k or transferred to an IRA, then the solo, let me rephrase that. So one option is you can transfer it to an IRA or you can convert it to a full-time employer plan. So based on this Sally example I just gave, Sally will need to be offered the plan, that full-time employer plan, eligibility in that full-time employer 401k. If you decide to convert it to a full-time employer plan, you're going to have to do that by January 1st of 2026. So again, the example was that Sally worked, or excuse me, Sally was hired on November 5th of 2024. And then Sally worked 1,000 hours or more through November 4th of 2025. So that's Sally's anniversary date. So as a result, because there are 2 plan entry dates, In this particular situation, it depends on when in the year that employee meets those eligibility requirements. So as a result, because Sally would have worked 1,000 hours or more through November 4th of 2025, then Sally would have had to have given a chance to participate in a full-time employer 401k by January 1st of 2026. That's called the entry date. Of course, if you transfer the funds, if you decided to transfer your solo 401k funds to a traditional IRA, then obviously there's no plan to offer to Sally. So, and you wouldn't have a full-time employer 401k or a solo 401k, so there wouldn't be an entry date. But if you wanted to continue with the 401k, you would not be able to continue with the solo 401k, but instead you would have to convert it to a full-time employer 401k and offer that plan for participation to Sally by January 1st of 2026. So this same example I just gave for a 1,000 hour full-time employee also applies to the long-term part-time employee who works between 500 and 999 hours for 2 consecutive years. So let's say Sally had worked for 2 consecutive 12-month periods where she worked 500 to 999 hours. And let's say that her anniversary date was November 4th of 2025. And let's say that she had started working for your business on November 5th of 2023. Well, then you would have to convert that plan, that solo 401k plan, to a full-time employer 401k, and you would have to offer it to Sally by January 1st of 2026. So again, there are 2 separate plan entry dates, either January 1st or July 1st. It just depends on when in the year that W-2 employee becomes eligible to participate in a 401k plan and whether or not you convert that solo 401k to a full-time employer plan. Your only other option then would be to transfer it to an IRA, or you can transfer it to a full-time employer 401k for a business that you do not own. Let's say you go back to corporate America and the employer you work for offers a full-time 401k and you're a W-2 employee of that business, then you could transfer your solo 401k to that full-time employer 401k as well for the business that you do not own. You can also take a taxable distribution, but that's not ideal because the purpose of a 401k, which is a tax shelter vehicle, is to grow it for retirement. So you would have to pay taxes and penalties if you took a distribution. So that's definitely a last resort. Okay. So we kind of talked about this slide here regarding your main options, but it doesn't hurt to talk about it some more. So what are your options if you hire W-2 employees in your self-employed business? Well, if your solo 401k no longer qualifies, you have several non-taxable options. Option 1 is going to be to restate to a traditional 401k plan for your business. So as your business grows, that is your self-employed business grows, you can convert, it's actually referred to as restate, your solo 401k into a full traditional 401k plan. And then add employee eligibility provisions. And then you're probably going to want to implement safe harbor or matching contributions. So this is often the best solution for growing businesses. Is there a tax impact? No, it is not a taxable event. Your existing plan assets remain inside a qualified plan structure. So it'll need to be converted, restated to a full-time employer 401k. Let's talk about option number 2. So option number two is you can terminate that is close to solo 401k and roll the funds to an IRA. So when you terminate a solo 401k, you're going to roll the assets to a traditional IRA. If there are any Roth solo 401k funds in the plan, those would get rolled over to a Roth IRA. It would be considered a direct rollover, where the funds and investments are directly rolled over to the traditional IRA and the Roth IRA if you also have Roth funds inside that solo 401k. There's no tax impact either when you perform a direct rollover to an IRA and or a Roth IRA. So it's not a taxable event as long as it's done as a direct rollover. As a result, funds maintain tax deferred and or Roth status if you also transfer funds to the Roth IRA. Now let's talk about option number three. So option number three is rolled to a new employer 401k plan. So you would roll the funds to a new employer's 401k, and this is because you closed your business and then you take a W-2 job where you are not an owner. So let's say you go and work for NVIDIA. So now you become a W-2 employee of NVIDIA. So as a result, you can roll your solo 401k funds into your new employer's 401k, in this case, the NVIDIA 401k, assuming the plan accepts rollovers. And most 401k plans out there accept incoming direct rollovers, transfers from other qualified plans, including a solo 401k or even IRAs. And there's no tax impact either when you process a direct rollover of the solo 401k to a full-time employer 401k. So it's not a taxable event as long as it's completed as a direct. Actually, oftentimes it's referred to as a direct rollover, but it's technically a trustee transfer because you're going from one 401k to another. But I don't want to get too technical here. Direct rollover usually means when you move it from a 401k to an IRA. But again, in the industry, you'll often hear the terminology direct rollover to even refer to the transfer of a 401k to another 401k. So let's talk about in what instance it would be consider a taxable distribution, which is something you don't want. Obviously, you never want to take a distribution from your retirement account unless you need to use it for retirement purposes. Because again, the purpose of any type of 401k or an IRA for that matter is for saving for retirement. That's why they're referred to as tax shelter vehicles. So it would become a taxable event if you take a distribution from the solo 401k plan. Unless you roll it over to an IRA within 60 days, that's called a 60-day rollover. So again, that should be a last resort. That is taking a distribution from your solo 401k because you're no longer eligible. Instead, you should consider transferring it to an IRA, a full-time employer 401k, or to your own business full-time employer 401k if your business grows and you want to continue to offer a 401k. So I don't see any other questions at the moment. So let's talk about what if you want to keep your solo 401k structured. So from a planning perspective, some business owners try to limit employees under 1,000 hours. So if that employee works 999 hours or less, then you can continue with the plan. So a lot of self-employed businesses will try to time it and make sure that individual does not work 1,000 hours during that 12-month period. And you also want to monitor for the 500-hour thresholds carefully. So again, that's the long-term part-time employer rule, where if you employ a W-2 employee who works between 500 and 999 hours for 2 consecutive years. So if you're trying to time it, then maybe year 2, you're going to try to make sure that individual works under 499 hours, so that he or she doesn't meet that 500 hour or more threshold period for 2 consecutive years, and then it'll restart over. That 2-year period restarts. It's got to be a 2 consecutive 2-year period. So this could work short term from a planning perspective, but it requires careful payroll tracking and planning. So that's something to be aware of. So as your business grows, transitioning to a full-time 401k is often the cleaner long-term solution, because you're able to keep your tax shelter retirement account structure intact. So from strategic, let's talk about a strategic planning tip. So before hiring a W-2 employee, you're probably going to want to try to project the number of hours that you're going to need that individual to work for your business, and also try to figure out your business growth trajectory, and whether or not you're going to want to have a full-time employer 401k down the road. And you're going to have to consider administrative cost differences, because it's a lot less expensive to have a solo 401k than a full-time employer 401k for your business. So planning ahead can prevent compliance headaches later. So from a final takeaway, hiring employees is definitely a milestone, but it changes your retirement plan obligations. So when you hire 1,000-hour employees, they become immediately eligible to participate in a plan once they've met that 1-year threshold and a 1,000-hour requirement. You've got that 500-hour employee rule for 2 consecutive years. That's called the long-term part-time rule. So again, as a review, you're going to have 3 primary paths once you have a W-2 employee who meets these eligibility requirements. You can restate to a full-time employer 401k. So as your business grows, you can convert that existing solo 401k to a full-time employer 401k for your business. It's often called the traditional 401k. Option 1, that's option 1. Option 2 is you can transfer the funds to a IRA. That's a non-taxable direct rollover. Or option 3, you can transfer your solo 401k to your full-time employer 401k. That's if you go back to work for an employer where you are not an owner. Like using my NVIDIA example, let's say you go back to the corporate world and you start working for NVIDIA, then you can transfer your solo 401k to that NVIDIA 401k if you're participating in that 401k. And of course, the last thing you want to do is not take a distribution from your solo 401k, because that's going to trigger taxes and penalties depending on your age. So if your business is growing and you are unsure how hiring affects your solo 401k, it's going to be important to review with your plan provider the timeline before making changes. So you always want to be proactive. So if you're proactive today, it's going to prevent costly corrections tomorrow. All right. Let's see if we have any other questions. I think that's all for today. If you haven't yet, please like and subscribe, as it helps us to get the word out to other solopreneurs like yourself. If you subscribe to our YouTube channel, we'll make sure to send you notifications regarding when we go live. We typically go live at least once a day, oftentimes twice a day. For example, we'll be going live again here in a couple days. So if this information is helping you feel more confident about your retirement future, please like us across the various social platforms. Please also visit our community website, which you can get to it by going to our homepage and clicking on My Community at the top there, where we have over 30,000 members. You can participate in forum posts. All right, well, thank you so much for investing your time with us. We'll be back again here in a couple hours. Until then, have a good rest of the day.